Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. A reminder that on Wednesday, the 10th of July, we are coming to Melbourne to do a live podcast. We cannot wait. The evening is going to be highlighted by a live Pimp My Portfolio session where Ren and I will be going through our portfolios, every single position with Luke Larrative to get his thoughts on how we might be able to improve our portfolios, just like we do it with community members on the show. So if you want to see what is in our portfolios and see if Luke can roast us, then come and join us at our live event in Melbourne. We're also doing an Ask an Advisor session as part of it where we'll be bringing in Dylan, one of our advisors, where you can answer all of your questions from the night, as well as we'll be unpacking the news headlines just like we normally do on the show. So come and join us. It's Wednesday the 10th of July. Tickets are available at equitymates.com/events, and I think there's only about 20% left or so. So make sure you grab one. We cannot wait to see you there. My name is Bryce, and unfortunately, I am not joined by my equity buddy Ren. He is off taking some time in Turkey. So I've taken the opportunity to sit down today and explore an asset class that I would like exposure to in my portfolio that I don't currently have, and that is private equity. So I've brought in the big guns. I'm happy to have the opportunity to speak to Claire Smith, Head of Private Asset Sales, Australia and New Zealand at Schroders. Well, Claire, welcome to Equity Mates.
Thanks for having me.
Now, before we get started, I want to do a bit of an overrated, underrated to get your views on some other asset classes outside of private equity. But firstly, we'll start with overrated or underrated, the current cash rate in Australia.
I think it's underrated. I think it could even go higher. I mean, there's still a lot of demand in the system. I think people are still spending. It hasn't quite curtailed. Inflation's still a little bit above the target. So, yeah, I think people are assuming a reduction a bit sooner. Could even go up.
I saw a chart the other. Yeah, well, look, I tend to agree. I saw a chart on ABC News recently that showed the differences in spending per age demographic, and I think sort of 18 to 40 have really pulled back. 40 to 60 are still below inflation rate, but the 60 plus...
The cashed up boomers.
Yes,
I know.
Spending like crazy, so
Ruining
come
it for
on.
everyone else.
Anyway, overrated or underrated, the S&P 500?
I'm going to say overrated just because I think it's very concentrated in very big tech companies.
Yep.
And as you'll probably find out during this podcast, we like small to mid-cap. We think there's more simple multiplier effect. It's much easier to double the size of a smaller company than a bigger company. So, yeah, I'll say overrated.
Nice. Looking forward to unpacking that. Overrated or underrated Australian property?
I have to say overrated. I don't know. But it's such a complex... So finally got into the property market last year, 18 months ago, and it hurts. And 20 years financial experience, and if I'm struggling to get my head around the interest payments, like what's everyone else doing? But then the boomers as well, are they going to pass the cash down to the...
Well,
is it going to be a case of haves and haves nots? If your parents are in the property market, you get a leg in. If not...
Yeah. I think this wealth transfer that is happening, well, we're starting to see at the moment is certainly, you're either unfortunately in it or you're not.
Yeah.
And finally, overrated or underrated Bitcoin?
I'm going to say fairly rated.
Wow.
Disclaimer, our household is very long crypto.
Okay. No, I was not expecting that. That's good.
But I think I like the deflationary aspect of it, of Bitcoin, and I think especially with governments printing more money, that's nice, and the decentralized finance has its appeal, but then the functionality of Bitcoin is a bit iffy. So then the other coins get created, and then the more other coins that get created, it dilutes the deflationary impact of Bitcoin. So I think it's I think it's probably fairly valued.
Nice. Well, we're not here to talk about any of those asset classes today. We're here to talk about private equity. Now, I want to, couch this conversation in the fact that I'm actually looking to get a private equity exposure in my portfolio. Don't currently have any.
Yep.
I want to speak to you today because I want to get a better sense of how the industry is structured and how I might be able to bring private equity into my portfolio.
Yeah.
Because it's for the Equity Mates community as well. It's an asset class that is slowly becoming more accessible, but certainly we're becoming more aware of, the returns that it's pumping out and the type of companies that you get exposure to. So let's start with, firstly, why should I consider private equity? Give me the pitch.
Sure. Well, I think listed markets are reserved for only companies that have the size and scale to deal with all the regulatory compliance, quarterly earnings cycles. So for a cycle, so for a starter, if you invest just in listed markets, you're looking at mostly the bigger end of town. So there's that company diversification point of being able to access companies at different stages in their life cycle, smaller companies, startups, etc. But quite simply, private equity's returned a higher return over a long time horizon, higher than listed markets, and delivered it at a lower volatility. And I think as well the way private equity manages company in terms of you buy what you think is hopefully a good quality company at a good price, and then everyone's highly aligned to grow and grow that company and then sell it within a sort of 3 to 5 year time horizon. It's more, I'd say, a formulaic approach to investing. Listed markets, there's a lot of momentum, a lot of psychology priced in, people panic selling at the wrong times, and so you remove a lot of that as well from private equity. So I'd say it's more pure, just company selection.
Yeah, it feels like a simpler, nicer, less emotional way to invest your money. Pure, good long term. So talk us through how the private equity market is segmented. So I think for a lot of the Equity Mates community and for myself, the headlines are driven by the big guys, KKR, Blackstone. They're also listed, and we can get access to those.
Yep.
Talk us through where it goes from there.
So you start from everything from angel investing, which is kind of, an idea, through to then venture capital. So venture capital, we do invest in venture capital, but it has to be a revenue generating business. So it's got an idea, there's a product, it's generating revenue, but probably not profitable yet. So then we move through to that growth phase where the company is making good revenues, it's actually got quite a big client base, but it's not yet profitable. Then you move into what's called buyout, coined by the old management buyout terminology, and that we further segment into small, mid and large cap. And as you're sort of alluding to, the KKRs, they're the sort of large cap of that buyout segment. And then you've even got turnaround, so companies that are underperforming that you think you might be able to inject new capital in, fix certain processes, and turn back into profitability. So that's, I guess, the sort of life cycle. And when you think about listed markets, you're really usually only investing at that sort of larger buyout part of the market. So private equity, you've got, the angel investing, the venture capital, the growth, through to buyouts, and then, as I said, sort of turnaround as well. And
are the turnarounds the guys that get the bad rap for coming in, leveraging up, ripping everything out, spinning it out the other side?
Sometimes, but not always. So we had an investment in, remember the old Philips sound system? Maybe you're too young to know. Yeah, the Dutch company. Yes. So they just weren't, not a good business, not doing particularly well. We were one of the investors, rebranded, so now they're premium sound systems, so they kept the old acronym, but they also converted to working with electric vehicles a lot to put in engine sounds into electric vehicles to improve road safety for pedestrians and other cars.
No way.
So that's a turnaround, but it's a good story actually. It's got a good ESG story as well, and a good outcome. So it doesn't have to be rip everything out, put in a bunch of leverage, fire everyone. Maybe some people have to get fired, but no.
And so there's a huge amount of capital in the private equity asset class.
Yep.
When you look at that segmentation, where is most of the capital deployed?
Yeah, so particularly when you look at that buyout, that kind of profitable part of the market, 70% of capital is going to the large end. So that's companies we define as greater than $1 billion of enterprise value.
Yep.
So total valuation more than $1 billion.
Yep.
Whereas only 30% is going into the small to mid cap part of the market. So companies of less than $1 billion of valuation. valuation. So, and then when you look by number of companies, there's like a lot fewer number of companies at the larger end and a lot greater number of companies at the small to mid-cap end. So we like that small to mid-cap part of the market because there tends to be sort of less cash chasing a lot more deals.
Yeah, so just to put some numbers to that, in research for this, I was reading a white paper done by Schroders. I think it's in the lower mid section. There are 440,000 businesses roughly, with about $37 billion deployed. But you compare that to the top end where there's about 2,000 businesses in the large cap with $366 billion deployed. Which is just stark. What inefficiency does this then drive? Like what problem, or is this causing a problem in the market?
It's not a problem per se. I just think people, so it's all about return on effort in a way. So the thing about private equity markets is, unlike listed markets, you can't just go and buy a company on the stock exchange. So you need to sign a non-disclosure agreement, you need to undertake months of due diligence, analyse the company's financials, analyse the client base, what's the sort of turnaround or plan for the company going forward. You need to build it from the bottom up, and that takes a lot of time and effort. So if you think about, and I'm going to pick a bit on the big Aussie super funds, they're now hundreds of billions of dollars, and I think private equity is the one part of the market where individuals like you and I actually have a leg up on the big industry superannuation funds because they're so big now, and with the valuations and the due diligence they have to undertake, they kind of can't get out of bed for less than $100 million ticket size. It's just not worth it when you're managing a $200 billion portfolio. So the smaller end of the market, yes, it takes the same amount of time to analyse that company, but if you've got the right team structure and the right coverage of the market, you can employ the time to go and due diligence that smaller company and then write a check. So we actually cap out at about $100 million. That's sort of our maximum ticket. So we'll go and do all the work, due diligence the company, and then invest $20 million. That's our, I guess, secret sauce. But not many people will do that. So that's why there is a price differential, because you think about that 30% of capital but 2,000 by number of companies, that's very efficiently priced. Because you've got the big private equity funds, you've got the big Aussie superannuation funds, the big Canadian pension plans, all these people who need to deploy large amounts of money, and they're forced into that larger end, or they prefer to stay in that larger end, because if you're at the larger end, you can raise bigger funds, you can write bigger tickets, you can charge fees on a higher amount of money. But at the smaller end of the market, same amount of effort, but you're writing smaller tickets. So it's not, from a Schroders business perspective, to be fully honest, it's not our most efficient economic use of time, because we're deploying, we're using a lot of people to write very small tickets, but the returns stack up. So you get paid a premium so basically the companies are cheaper at that smaller end of the market because there's less people chasing those companies, and it's very fragmented as well. So if you want the higher returns, you got to roll up your sleeves and do more work for smaller ticket sizes.
So then where do these super funds go in 5 or 10 years? Like, is this just going to be further, I guess, elongated, if that makes sense? Like the discrepancy is just going to become more and more? I
think it kind of has to, because of the focus on fees, because, if a lot of the superannuation funds, I guess they want to internalise, because under the APRA heat map, they have to post their fees and everyone picks the fund with the lowest fees. But I sometimes think, you pay peanuts, you get monkeys.
Yes,
And so we focus on net of fees returns, obviously.
Yep.
That's I think, what you and I care about. We don't mind as much what we're paying in fees as long as we're getting a good net return.
Yep.
But obviously the superannuation funds are in a bit of a sticky spot where they have to show their returns on one side, but their fees completely separately on the other side. So they need to try to generate those higher returns, but still make their fees look lower.
Gotcha.
So, they're just trying to get, I guess, forced into cheaper investments at the larger end of the market. So, it'll be interesting to see how that plays out, if that's the right strategy or not over the next 10 or so years.
Yeah, it's fascinating. I can't, they're just going to have so much cash in 10 years' time. What are they going to do with it?
I know.
So I don't know if it feels like that Schroders believe it's a misconception, and I'm starting to, I guess, come around to it as well. But when we have initially been speaking about private equity and where you should be investing to get the returns, it's that you want to be with the big guys because they get the best deal flow. they get the Canvas, they get the Ubers, you know what I mean?
Yeah.
They get these sexy big tech companies
Yep.
that if you're down in playing in the lower to mid where there's 440,000 smaller businesses, you're missing out on that and therefore missing out on these big tech returns. What's the counter argument to that?
It's simple supply demand, as I said, the big guys are all sort of chasing that same cohort.
Yeah.
And if you think about it, because everyone at first was saying private assets, you get an illiquidity premium. That's why I invest in private assets, which is just a fancy way of saying you can kind of buy a company more cheaply because it's not listed.
Yeah.
Because you have to do that work, you have to, sign an NDA, due diligence the company. But the big guys are taking listed companies private at a premium to its listed price, which implies there is no illiquidity premium anymore in the larger end of the market. So we think, and not to say these aren't good managers, I mean, these big guys can buy a good company, they can implement operational efficiencies and drive returns, but it's not about just a liquidity premium anymore. It has to be about that company thesis. What are they going to do when they buy the company? How are they going to run it more efficiently? And we think it is cheaper to run a company privately than it is to have it listed, but that's kind of not enough in a way. You need to do all the other, have the plan for how is that business going to grow. But at the smaller end of the market, it can be simply we found a company and we've bought it and no one even knew that company was for sale. So 60 to 70% of the companies we buy in the small to mid-cap part of the market are previously family-owned or founder-led businesses.
Yep.
And it's often not, they don't even know they want to be sold. We're in with our partner managers actively pitching to them and, sort of saying this can be your succession plan, because we're finding a lot of previously family-owned businesses, the kids don't want to run the old, family business anymore, and that's where private equity can step in. So, 60 to 70% of the time we're the first institutional capital in this business. But, even taking sort of one step back, we have a database of 5,000 private equity managers around the world that we track and monitor, and we segment into the different parts of the market that we like. So we look at, venture, we like sort of early stage, not late stage. Buyouts, we like small to mid cap, not large cap. We've got our geography and sector preferences. But through that filtering, we've then found 300 managers that we want to partner with, who invest into the types of companies and the spaces that we like. And we partner with them in order to, access these companies that, as I said, might have been founder-led, family-owned businesses, because I think as well some people conflate small with new. But these companies can often have been operating for decades. Yeah. But it's just, I would say that, someone sets up a company, and then they're not an expert though across sales and marketing, operational efficiencies, M&A, or maybe they haven't had the capital to expand into a nearby geography or expand vertically along the supply chain. So this is where private equity can come in, and they do have those skills to implement that plan to grow the company from a sort of small boutique family-owned but well-regarded company into a more professionalised and more sort of industrialised company. So that's always our strategy, is find these attractive companies that are under the radar of a lot of the sort of big guys, have a plan for how we're going to, whether it's increase sales, reduce operational efficiencies, as I said, expand into surrounding geographies, because particularly, say you look at regions like Europe, lots of language barriers, lots of different sort of regulatory regimes if you want to, expand from Spain into France or something. So how are we going to help that company grow? And then we typically, even 90% of the time, we're just selling upmarket to a bigger private equity fund or another corporate in that same sphere, and they'll pay you a higher price because you've taken what was maybe a well-run and well-regarded company, but they might not have had proper operational processes. They might not have had a proper governance structure in place. So you put all these things in place and you effectively make them bigger and more attractive for the sort of big guys to buy.
At which point as well, the premiums are going up and up as you reach the higher end of the market as well.
Absolutely.
So it's like an arbitrage in a way.
It is, yes.
Nice.
We call it buy low, sell high.
Buy low, sell high. That's interesting. Just randomly, but when you say you come in, improve sales, operations, that sort of stuff, do you have executive teams that you rely on to go around, or how do you actually work with the companies in the portfolio?
Yeah, so we operate by investing in third-party funds.
Okay,
and
purely?
We invest also directly in companies, but only really alongside those funds. Because our first step is we take that sort of 5,000 private equity manager universe, and then we filter it down into sort of our 300 key core components. And we're really active. We'll show you, all the managers we have in our portfolio. It's not like intellectual property or anything, because these are small specialised niche funds that you probably wouldn't want to put all your money into one of their funds, because we might invest in a fund that just does technology in Germany or the DACH region.
Right.
We have one of our sort of special sources as well is identifying spin-offs. So what we really love is we've got a fund in our portfolio called Archimed, which was a spin-off of 3i. All they do is healthcare investments. Their investment team is made up of all C-suite executives of previous massive healthcare companies. We've invested in them for about 7 years now. All their funds have been top decile, and suddenly they're on the radars of the big superannuation funds and the big sovereign wealth funds. So they're attracting attention now, but we've been partnering with them for a really long time. We've got another one called Fremen, which is a spin-off of PAI, which is a big European buyout manager. Because what we often like is first-time funds, but not necessarily first-time teams. So first-time teams brings a risk. You and I could go, let's set up a private equity fund. Yeah. But then sort of a couple of years in, we have a difference of opinion and, something goes wrong. When it's a team that's already worked together, because the sort of trend in, I guess, buyouts is a lot of funds start small to mid-cap and then they grow bigger because they want to raise bigger funds because you can charge fees on bigger funds. It becomes that more efficiency where you can write a bigger ticket, invest into a bigger company, but you do, as we sort of discussed, dilute your returns in exchange for going bigger. So we like teams that think, no, actually, we want to go back to our roots. We want to go back to small to mid-cap, where we can extract higher value for the investors and themselves, because there's normally performance fees in private equity funds. So as I said, sort of first-time funds, but often teams that have worked together previously, proven their core competencies. And then a lot of what we do is reference checks. So if they say, I invested in XYZ company and we made 5 times our money on that company, we go and ring people who worked at that company and say, who bought your company, who was involved in the day-to-day running of the company, and we reference check, because everyone will try to put their name against a good deal and say, oh yeah, I was involved in this. Yeah. That was us. So we have to do the reference checks and say, was Bryce really the one who was sitting on your board? Was he really the one who was, helping you execute your plan? And if not, have another look. But if it all checks out, that's when we want to back those sort of, early small funds. And then what happens then is, so we invest into their funds, but often there's a thing called a co-investment. So imagine, we're going to raise a fund for $300 million and we need to make 10 company investments to give diversification so we can write $30 million checks. But we find a company we want to buy that's worth $50 million. So you agree to put 30 in the fund, and then you invite your investors to co-invest and take that extra 20 million as a direct investment.
Yep.
So because we focus on small funds, because we're often their first and most institutional partner, we get a lot of co-investment capacity. So we do invest directly in the companies, but we always rely on those managers to be the ones running that day-to-day plan, sitting on the board, sitting on the management team, executing that plan. And then we usually sit on their advisory board, so every quarter we see what they're doing, but really they're the experts. They're the ones who, have the local sector and, regional expertise. So we do rely on them to be the ones sort of running that value creation plan, and then we just monitor and track it.
Interesting. So this is all sort of captured in the Schroders Specialist Private Equity Fund.
Yep.
So if I'm investing in that in you guys, really I'm investing in you guys to make a good choice in fund managers below that, or private equity managers below that in these niche areas.
Exactly, yeah.
What's the general time frame that you have investments within these portfolios? Like, is there time horizon?
So usually our average company hold period is 5 years.
Okay.
But the fund is also investing in traditional private equity funds that have sort of 10-year lockups. So I always sort of think, from an Aussie investor perspective, this fund gives you access to a globally diversified portfolio of managers and portfolio of companies, because manager concentration risk is something to think about. As I said, you might not want to put all your money into a German technology fund, but you might want to put 3% into a German tech fund, like 5% into a European healthcare fund, 5% into a US tech fund. So we will curate that portfolio of managers and companies within the fund. So
this is just another, it's really an alternative, and we'll get to the specifics of it in a moment, but it feels like it's just another alternative for listed equities small cap, if that makes sense, or mid. Like, just like I would go out and find a fund manager here who's investing in the German tech company or whatever it is that a fair comparison for how the Equity Mates community might think about getting access to this part of the market?
Yeah, it's a bit. I mean, the access is a bit different. Obviously, as I said, there's no benchmark really available for private equity, or if there are benchmarks, you have to sort of pay for them. So manager selection in private equity is, I think people are scared about private equity because it's quite opaque.
Yeah.
Because if you want to invest in European listed companies, you can look at the FTSE or whatever the Euro stocks and see what's that index doing, how's the manager performed. With private equity, in order to get benchmark data, you usually have to pay for it. So we, subscribe to a lot of different benchmark data and we can sort of get it and track. But the dispersion as well between manager returns in private equity is massive. So if the average has been sort of low double digits, sort of, 12 to 13%, bottom quartile is 0 and top quartile is 20%.
Right.
So if you pick the wrong manager, and often it's hard to get out then of private equity. So you really need to do your due diligence before you invest. We always sort of joke it's like a marriage,
But if it's so opaque, is it easy to get that info?
Well, that's where you come to Schroders. We'll help you out. No, you sort of read our white papers. We do a lot of work on mapping the market. Where are the returns of the market? Because we do want to be as transparent as possible. Because when we launched the retail fund, we sort of said, what are the main impediments to investing? It's high minimums, long lockup periods, opaqueness of the market, and then expensive and complex fee structures. So we've tried to sort of hit all those nails on the head. But the returns, and there's a lot of jargon. There's IRRs, MOICs, TVPI, DPI. Like, you can get lost in a world of acronyms. So we do try to sort of demystify that a lot, and because we want to educate people. And then we also say, sounds like I'm negative on large cap. I'm not. I'm just more bullish on small to mid cap. But you can have a large cap manager and you can have a small to mid cap manager in your portfolio the same way you might in your listed portfolio.
Yes.
But I think the difference between picking a listed manager is you can track them independently, you can you can review the stocks yourself, you can see if you think that's a good investment or not. Private equity, you do have to have a bit more trust in the manager. Which is why I think Schroders has been around for 200 years. We might not be as well known in your community, but we're one of the longest running continuously family owned businesses in the world. So still
family owned.
Almost. Well, the Schroder family owns almost 50%. We're listed on the London Stock Exchange.
Wow.
That sort of hopefully gives a bit of trust to people that we're not sort of a fly by night. You know, setting up a private equity fund, give us some money, and then hopefully you hear from us. We've been in Australia for 60 years now. We manage almost $1 trillion Aussie dollars of assets under management. So we do try to give with private equity a lot of information and a lot of trust around that you're sort of getting access to, what we think are best-in-class managers, and we'll give you as much data as we can around that. But it's definitely a bit more, you need to sort of get to know the manager a bit more, get to trust them a bit more, because as I said, listed markets, you can do your own research and are they long or short NVIDIA, or do I think that's a good or a bad investment? With us, it's a bit more difficult. And sometimes we'll have companies in the fund and someone will ask a question and we can't answer because they're about to go through some M&A activity and it's confidential.
Yeah.
So as well, we always have to apply within the bounds of, recently a consultant said, can you give us a list of every single company in the fund? What's its last 12 months sales? What's its EBITDA margin? What multiple you paid? And we were like, no.
Sorry.
I'm sorry. So we try to be as transparent as we can within the confines of confidentiality agreements that we have signed with these companies.
Fair. Well, you said a couple of things there. You said lockup periods and also access. Yep. And I think for us as retail investors, this asset class, those are the two, as you said, the two big hurdles.
Yep.
So
if you don't have $10 million.
I don't have a personal balance sheet that can get in on a lot of these big guys. And so when we're saying access, a lot of these funds have minimums.
Yep.
And when we're saying lockup periods, a lot of the funds require that you put your money in and you can't access it for 5-10 years, whatever that period may be.
Yep.
And so as retail investors, that does prove a little bit challenging when, again, what you put in, you might need within that 5-year period or whatnot. So how does the specialist private equity fund differ in that regard?
Yeah, sure. So because we have such a big platform in Australia, and we manage Aussie equities, fixed income, multi-asset. So we've got a $20,000 minimum direct application for the fund because it fits within all the other funds that we manage within Australia.
Yeah.
So, $20,000 minimum and then 5,000 additional contributions if you want to top up. I know you guys like averaging in,
yes.
So do I. So that sort of tackles that access point, the size of investment.
Yep.
And then in terms of liquidity, so we have monthly applications, so you can apply every month, and then we have quarterly redemption cycles with a 1 quarter notice period. We do try to be upfront though that the fastest you can get your money out is 4 to 7 months, because we require a quarter notice period, so 3 months notice period, and then it takes us a whole month to calculate the NAV of the fund, because we have to go and individually value all the companies within the fund. So if you put your redemption request in on the 31st of December, you won't get your money back until sort of end of August, maybe even beginning of May, because there's some Easter holidays in there, because it's like 22 business days. We always say don't wake up hungover on the 1st of January and put your redemption request in, because then you've missed the 31st December cutoff, and you actually won't get your money back until the end of July. Because because we would accept your redemption request on the 31st of March. You'd be processed on the 30th of June, and then you get your money out after that. And there's also caps and limitations around redemptions that we should be completely transparent with. So 5% of NAV per quarter of the net asset values of the fund. So there's about 1.7 billion US in the fund. So for you
it's
and I, you can get out of that 80 odd million US dollars in a quarter.
Yes.
But I would say it's circumstantial liquidity. So if you decide you want to buy a house and want to withdraw from the fund, hopefully that should be fine. But if there's like a GFC type environment and everyone does what they shouldn't do and try to panic sell, the fund does have the ability to cap redemptions.
So it's not guaranteed, so to speak, but like in most circumstances there's that liquidity. And so when you say semi-liquid, it's because unlike the stock market where I can go in and place a sell order right now and probably get it filled within a matter of seconds. You're providing liquidity opportunities, but on that quarterly period time frame.
And it's all perspective, because if people are used to a 10-year lockup, they go, I can get my money out in 4 to 7 months. That's great.
It's great.
If people are used to T+3 settlement on their direct shares, they're like, it takes 4 to 7 months to get my money out. So it all depends, but as we all know, there's no such thing as a free lunch in financial markets. And if you want access to privately held good quality companies, we think this is sort of the most balanced way we could do it to give you true pure private equity exposure.
Well, I think you said at the start, like, you want to be going into this sort of model understanding what you're trying to achieve, which is taking a business through a part of its life cycle, and that can be 5+ years.
Exactly,
so needing the liquidity is probably not as important. But obviously life throws challenges, and having that option is good. Given that I'm obviously doing this through the lens of wanting to my own portfolio, how do your returns for this fund measure up against, I guess, players in the space?
So there is a premium into being small to mid cap. So when you look at like funds, as we said, only 30% of funds by dollar operate in the large cap part of the market, and then 70% by dollar in the large cap, 30% by dollar in the small cap. But when you look at top quartile funds, it's actually 50-50. So even if you throw a dart at a small cap fund, you've got a better chance of getting a top quartile performance than if you were to throw a dart at a large cap manager. So we've returned sort of 17.6% since inception of this fund in Australia, and that's net of fees and cash, etc., within the fund. So we've slightly outperformed.
How many years is that?
That's 4 years now. We've got 4 years of data. The team have a 25-year track record, and this 4 years is in line with their longer track record, but we just launched the semi-liquid fund 4 years ago. Prior to that, we were just managing those traditional closed-end funds with the $1 million minimums and the 10-year lockups. So still got a lot of AUM and clients, a lot of institutional clients invested in those, but this is our sort of first foray, which we launched 4 years ago in the semi-liquid space. But we always say the returns for private equity, it will buffer on the downturn because of the way we value the companies and the discount rates we use. So we use quite different discount rates to what you would use in listed markets, but we'll also lag on the rebound.
Right.
So 2022 was a great year to be in private equity. We offered a lot of protection against listed markets and particularly fixed income markets. But then 2023, actually, you would have rather have just been in S&P 500 and you would have done better. Yeah. But it's
less volatile.
Yes, definitely. So it's always a much more smoother trajectory, it should be. And also because we only value every month.
Yeah, you don't have that daily or every second.
So it's a sort of smoother trajectory, but we've got stats showing what have listed markets done over sort of 15, 10, 5 years. So Cambridge Associates does produce the private equity benchmark. What's that done over 15, 10, 5 years? And then what's our portfolio done over those periods? And we've outperformed listed markets and we've outperformed the private equity index over those periods.
Wow. So I just want to close out with getting a bit of an understanding around your investment philosophy, I guess, and then maybe if you can bring that to life with an example. You've spoken about some of the managers that you're investing in and German health tech and those sorts of things, but how would you describe the investment philosophy of Schroders and the fund, and then perhaps an example that illustrates that?
Yeah, sure. So we've got our sort of top-down views. As we've said, we like small to mid-cap in buyouts. Regionally, we invest across Europe, North America, and then Asia, mostly China and India in Asia. So we've got our sort of regional, and the team is structured in a way to reflect that, because we believe you have to speak the local language, you have to understand the local culture. So we've got teams across London, Zurich, New York, Beijing, Shanghai, Singapore, all who can, liaise and conduct due diligence in local language. Their claim to fame is they speak every European language except Hungarian and Finnish. Nice. So, if they're due diligencing an Italian buyout manager or an Italian company, they can do it in local language. They can conduct reference calls in local language, which they say you get a lot more honest response if you're talking to someone in their mother tongue rather than forcing someone, to speak English. So we've got, and everyone has a regional specialisation which aligns to their sort of, language and geography skills. But then we complement that by sector specialists. So our 5 sectors that we invest into are healthcare, tech, consumer, business services, industrials. They're our 5 verticals. Okay. So every time we do a team, if we're doing like a US tech, it'll be someone from our US team supplemented by someone from the technology sector. And then we have 1 or 2 analysts as well on the team. So we put together these deal teams that cover our regional specialisation, our sector specialisation, and then it's all about bottom-up investing. So what's the plan for the company? Or if it's a fund manager, what's their strategy? Is it sales expansion? Is it operational efficiency? And we'll analyse all the deals they've done, either at this firm or at previous firms. So our database, we try to tag, as I said, if it's like a PAI spin-off, we'll look at the deals that they did at PAI, as I said, do the reference checks, make sure they were really the one, and we'll analyse the investments they've made, when they've exited, and how did those returns get driven. So we want to see returns driven by sales expansions or operational efficiency or M&A activity, not just leverage. We do see a lot of what's called the multiple expansion, which is the fact that we're buying companies at cheaper prices, growing them, and then selling them to someone who pays you a higher price for that company because you've grown it and professionalised it. So we're okay with that, but you don't want to see just that, because that can also be a bit of momentum built into that as well. So a lot of due diligence, like weeks, months, healthy debates. We've got an investment committee who've been working together for 15 years, based across Zurich and New York. Every deal, fund, any investment has to go through 2 rounds of investment committee where they really challenge, spark debate and make sure that this is a company, because the thing about private equity is once you made your commitment, you can't get out. So you really have to do a lot of due diligence at the outset, and then obviously we monitor throughout, but there's not many sort of escape plans if you make the wrong decision. So that's why there has to be so much healthy debate around initial investments.
Yeah. And what about an example?
Oh, yeah, sure. So we've got an example of, we've been talking about Germany, maybe, a German consulting firm.
Okay.
So this is a company founded in 1995, so as I said, not new. We made our first investment in them when the fund sort of first launched at the end of 2019. And they're a technology consulting business based out of Germany. And we invested in this alongside one of our sort of German consulting and tech specialist private equity managers. So really small company, they were only making 9 million euros of EBITDA when we first invested. And we could see a growth plan where that was going to grow to sort of 13 million over a few years. So also we quite like asset-light businesses. So we don't want them to own big bits of property or, big pieces of machinery. We quite like companies that are asset light. So if something does retract in the economy, their cost base can be retracted accordingly. Great team. And actually, when COVID hit, we valued the company down because we thought, it's the first thing people stop spending money in a recession. It's consulting fees. But they actually then pivoted to help the German government work from home. So they were helping them adjust for all the right protections from people logging on remotely. They became the software that activates German passports and connects them to the World Wide Web, whatever it is, the passport system. So we'd projected, as I said, that the revenues would sort of go to 13 mil. It grew to 25 mil within a few years. So they were winning a third of all contracts issued by the German government in the technology space. So after about a 3-year investment period, the manager and us decided to put the company up for auction. We thought we'd make about 5 times our money in 3 years. Actually, a last-minute bidder came in and bid 6 times our cost. But we still liked the company so much that we actually decided to take half our profits off the table, and then we rolled half of it into a continuation fund alongside the new manager who bought the company. So we sort of, took a lot of profits off, and then that investment in the continuation fund, it's only been going for about 12 months and it's already marked up 2.2 times that price. So again, and we were comfortable doing that because still liked the thesis, liked the team, sticky remunerative contracts with the German government, and still very much within that small to mid-cap segment that we liked. So it's still in the portfolio today, but we've also taken some of our profits off the table, which is always nice as well.
Fascinating. We are learning more about the continuation fund model as well, where you guys just keep your best ones and roll with it, which is another interesting part of the industry. But Claire, to close out, where do you think the industry will be in 5 or 10 years' time?
I think the sort of democratisation of private assets, if we could put it that way, is a trend that will continue. But I think there's funds that have been structured conservatively and well, I would say, and others that have maybe done it in a bit more loose manner. So we might see a bit of differentiation between those. I think it will be really interesting as well to see what plays out in that superannuation fund market as they're getting so much bigger. Because there's a bit of a question mark about sort of small to mid-cap, the viability of small to mid-cap private equity funds in Australia. I saw a stat the other day, I think the RBA, the ASE and Prequel put it out, showing that superannuation funds used to be 60% of all capital in local private equity funds. Now they're only 30%, and foreign capital sort of had to come in to bridge that gap because the superannuation funds sort of want to go direct a lot more than through fund managers. But I think, I think the private equity universe is it's an interesting place. I think a lot of people either think venture capital is large cap buyouts or just venture. But there's sort of like a big world in the middle. I sort of look forward to hopefully educating people more around that bit in the middle of private equity where it can be a boring German consulting firm, but where you make a really good return on money.
Can't complain with that. Well, Claire, I've certainly learned a lot today, so thank you very much. My search for a private equity position in my portfolio is getting closer, I think. But I think what you guys are doing in terms of the accessibility and liquidity is certainly helpful for us as retail investors. So thank you for taking the time today. I really do appreciate it.
No, thanks for having me on. It's a great podcast.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.